Welcome to week 4 of Accounting 102. My name is Paula White and I am your instructor. And what I have in mind today is to play a couple short videos to make the material relevant, and then do a review of the materials by working through some of the multiple choice quizzes that are available. So that hopefully will prepare you for the final exam. So let's get started.
Whether a company is a service provider or a merchandiser, each must keep an accurate record of revenues, expenses, profit or loss, assets, liabilities, and owner's equity. To do this, there must be a direct interplay between the nature of the business and the kind of information it uses and reports. Services providers sell time and knowledge, which generate fees and commissions. Merchandisers buy and sell products which must be tracked from date of purchase through date of sale. The complexities of a merchandising firm, in contrast to a service firm, show up on their respective financial statements. A merchandiser's balance sheet always contains the asset, merchandise inventory. The value shown represents the amount of inventory unsold at the balance sheet date. Obviously, a service firm will usually not have inventory on its balance sheet. When inventory is sold, it becomes an expense on the income statement and is shown as cost of goods sold. Again, cost of goods sold would not appear on a service firm's income statement. Cost of goods sold is just what it seems to be: the cost of buying and preparing for sale the merchandise sold. Deducting cost of goods sold from net sales gives gross profit, or gross margin on sales. Operating expenses, which consist of everything from payrolls to utility bills and rent to advertising, are subtracted from gross profit to arrive at net income or loss for the period. Now let's take a top-to-bottom look at a merchandiser's income statement. At the very top is the sales section. Sales is the total price for all the goods sold. Sales revenue is reduced for early payment discounts given to credit customers, and for customer returns of merchandise and other price allowances after the sale. Net sales is found by taking sales returns and allowances and sales discounts away from gross sales. Following the sales section is the cost of goods sold section. To find the cost of goods sold, we have to know the amount of merchandise inventory at the beginning of the period, to which we add the cost of merchandise purchased during the period. This gives the cost of goods available for sale. The cost of merchandise inventory at the end of the period, in other words, the merchandise not sold, is subtracted from goods available for sale. The result is the cost of goods sold. What was the gross profit from goods sold? The answer is found by subtracting the cost of goods sold from net sales. In this case, gross profit is $257,000 on net sales of $642,000. That gross profit figure looks pretty good, but it's not net income. There are other operating expenses, such as salaries and commissions, advertising and marketing, rent, supplies, and so forth. These are shown and added up for a total. Total operating expenses are subtracted from gross profit to arrive at net income or net loss. In this case, the company is showing a net income of $83,000, which is the bottom line. Typically, net income is a fraction of net sales. In the case of discount retailers, profit margins are extremely thin. Without proper management of inventory, revenues can quickly erode and net income evaporate completely.
Inventory for a company like On-Target Supplies and Logistics is what cash is for a bank. You should care what's in the vault.
On-Target, like many companies that use electronic data gathering, also counts inventory the old-fashioned way, by hand. The purpose of this physical inventory is to ensure that the electronic numbers match up with what's really on the shelves.
If we don't get good inventory counts, we don't really know if the balances that we're reporting are right.
At On-Target, employees perform physical inventories without knowing what's in the system.
We compare what is to what the system's suggesting that it should be, and we reconcile the differences. The way we reconcile the differences is being able to create justification statements or reason codes for the inventory not reconciling. The reason may be damaged product that hadn't been properly recorded and adjusted at that point. It may be product that was shipped without the proper shipping documents. And often, in some cases, but hopefully not too much here at On-Target Supplies and Logistics, it is inventory missing is because an employee or somebody that had exposure to the product took it without proper authorization.
The inventory walking out the door is obviously the hardest thing that we have to deal with. We run about 5 employees per store, and consequently 2 to 3 of those employees have a key to the store. And so that's one of the reasons also that we take the inventory so frequently, is because our stores have a lot of empowerment, and they're each one responsible for several hundred thousand in assets between inventory and furniture and fixtures. So, but that's probably the toughest one to catch.
Look at a merchandiser's financials. You'll see that inventory is probably the largest asset on the balance sheet, the revenue generator, and biggest expense on the income statement. Periodically, physical inventory counts are made to confirm or correct inventory records. These summary numbers are useful for evaluating the overall success of managing inventory. Accountants keep track of inventory by 2 methods, perpetual and periodic. With the perpetual system, each inventory transaction is reflected in the accounts as it occurs. Perpetual inventory systems allow managers to track inventory on a real-time basis. In contrast, the periodic system updates inventory accounts periodically, specifically at the end of an accounting period when physical inventory is taken. Some companies use both systems, perpetual for internal management and periodic for financial statement reporting.
On a year-end basis, I'd say the biggest difference between closing books on a monthly or quarterly basis versus year-end is that at the end of a year, the income statement closes out to the balance sheet, meaning we start the clock again, basically beginning at 0. That's why you start your revenue and expenses always from a 0 for any fiscal period, be that a calendar year or some other fiscal period. And the balance sheet of all corporations continues on. That's the highlights of what a close is about.
As I've discovered by listening to accountants like Maureen Tart, that the closing process has 3 major goals. First, to lock into revenues and expenses for the current period. Second, reset revenue and expense accounts to 0 for the start of the following period. And third, update owner's equity for net income or loss and withdrawals. Accomplishing these goals is a step-by-step process that begins with the adjusted trial balance. First, the revenue accounts flow into a closing journal entry that includes the income summary account. The revenue accounts are then posted and closed in the general ledger. Next, the expense accounts flow into a closing entry. Once again, the income summary account is used. The expense accounts are then posted and closed in the general ledger. Revenues minus expenses equals net income or loss. The balance in the income summary account measures the income or loss which is closed to the owner's capital account in the general ledger. Owner withdrawals is the last account to be closed. Like the other closing entries, it is posted to the appropriate general ledger account. The post-closing trial balance is the final step in the accounting cycle. It's a check to see that the ledger is still balanced after the adjusting and closing entries have been posted. Since the revenue, expense, and withdrawal accounts are all closed, only assets, liabilities, and the owner's capital accounts appear. In other words, the balance sheet accounts. The three main goals of the closing process have been achieved. Closing the revenue and expense accounts has locked in their numbers for the current time period. This also means that the revenue and expense accounts will be cleared to receive transaction data for the next time period. Finally, owner's equity is now up to date, reflecting net income or loss and withdrawals for the period. Like a wheel within a wheel, the closing process is part of a larger process, the accounting cycle. The cycle starts with daily transactions recorded in the journal. It ends with closing entries and a post-closing trial balance. In between is the ledger to which transactions are posted and adjusted. A series of trial balances checks the ledger. The result is a sound set of financial statements and an accounting system ready for the next accounting cycle. The year-end close is a process that should be built with hard facts and data tempered by professional judgment. But it's more than making entries, adding columns, and numbers. The goal at year-end is to present a clear picture of the organization's financial position and provide useful information to decision-makers inside and outside the company. A company's financial position is shown on the balance sheet. Balance sheet details can vary from one company to the next or from industry to industry. But basically, all balance sheets show assets, liabilities, and owners' or stockholders' equity. A classified balance sheet, which shows current and non-current assets and liabilities, increases the usefulness of a non-classified balance sheet to a variety of users.
The classifications in the balance sheet are important because they indicate they can speak to sources and uses of cash. For instance, current assets become a near-term source of cash, while current liabilities become a near-term use of cash. The amount of assets that are in the short-term working capital side of the balance sheet versus the long-term side are important, and they indicate options and flexibility. They can indicate options and flexibility that the company may have in future periods, depending on the proportion of assets that are in the current and long-term sections of the balance sheet. In the same way with liabilities, whether they're current or long-term, it indicates how quickly cash has to be captured to service the liabilities.
LaManelin does use a classified balance sheet. I haven't seen a whole lot of companies that don't use a classified balance sheet. The reasons that we do are simply to distinguish short-term obligations and assets from long-term. The things that you might find on LaManelin's balance sheet in terms of short-term assets are going to be cash, We have some receivables from our wholesale customers, the supermarkets, and we have a little bit of ingredients inventory, but not much because most of our product is, as I mentioned, 1 or 2 day type product, so it turns very quickly. The things that are large are the fact that we have to pay our people, and we don't pay them every day, so we have accrued payables to our own associates. And by far, an even bigger piece of the current liability side of the equation is going to be how much we owe our landlords. And rent is a very large obligation for LaMadeline as we rent and lease each one of our locations. I would consider our balance sheet to be very healthy. Our debt to equity ratio is strong. Certainly somebody's going to look at long-term debt. That's a large piece of the equation. The amount of debt versus equity is a large piece of the equation. And from a financial statement user perspective, people are more focused on our income statement, on our cash flow, and our ability to pay off our obligations and our long-term forecasts with regards to income statement and cash flow. And that all certainly translates into a balance sheet and a particular snapshot at the end of a given period. That's an example of why we use a classified balance sheet.
So, the year-end statements become tools for anyone interested in the economic story of the organization. I talked with a variety of decision makers to see how they put the information to use.
A balance sheet being classified into non-current and current assets is very helpful to looking at the financial short-term health of the company. When you're looking at a company that has current liabilities in the next 12 months, you want to make sure that they have enough current assets to be able to handle those liabilities, or the status of the company may be in doubt. If they don't have that ratio that's greater than 1, then you may have to look at what is the company going to do to meet its obligations. Current assets are assets that can be quickly converted into cash. Current liabilities are liabilities that we know are coming and that we have to meet some way, somehow. So as an analyst, when you're looking at a classified balance sheet that gives you the detail of current assets and liabilities, is very helpful.
Analysts like Louis Krebs find a classified balance sheet useful for assessing the value of an investment. They often look at the current ratio, which is a measure of a company's ability to meet its short-term debts, something bankers focus on when evaluating credit risks.
Obviously, if someone comes in that has a properly prepared financial statement where the balance sheet has been categorized, that helps us out quite a bit, because we truly are trying to focus on those debts that are coming due within that 12-month period versus those that have a longer-term payout. As far as what kind of ratios, we do a variety of ratio tests on the balance sheet and the income statement. But all in all, what we're trying to focus on is the liquidity of the company and its ability to cash flow its obligations. And then, of course, we're going to build in various tests to try to basically preserve the integrity of the balance sheet in its current state. I guess by that what I mean is, if we come into a company and it's got a 1-to-1 debt to worth and it's adequate equity in the business, we're going to try and put in some ratios that are basically going to preserve that same situation through future periods.
We prefer a classified balance sheet over a non-classified balance sheet simply because it takes less work for us to analyze the picture of the company. We're looking specifically at the makeup of working capital. Is it concentrated in inventory? Is it concentrated in receivables? And hopefully there's some cash on the balance sheet as well. So our preference is to see a high concentration in both cash and receivables, and to a lesser extent, inventory. Recognizing that inventory in a lot of cases is a very valuable asset. It's one, as a lender, hard for us to manage as collateral. So we're really interested in the receivables and the cash, and then their relationship to the current liabilities. And so from that standpoint, we get a better picture more quickly with a classified balance sheet.
Well, hopefully those 2 videos helped with understanding the relevancy of some of the information that you were presented with this mod. And the second video was a review of the closing process and kind of where it's trying to go in accounting and what it's trying to accomplish. And we do have a person on with us today, a student. And Katie, can you hear me? Is the video working? Good, that's great to know. And welcome, Katie. Do you have any specific questions from me today? I'm going to do a review by going chapter by chapter and doing some quizzes online. But if you have some specific questions, you're speaking for the entire classroom, so don't be shy. No, you didn't see them in the shell because I'm going to be working them here. They weren't provided. Okay, so this is chapter 6. And number 1 is the purpose of closing entries is it to transfer the results of operations to owner's equity, to reduce owner's capital account balance to 0 so that the account is ready for the next period? Is it to close all accounts so that the ledger is ready for the next period? Or is it to adjust the ledger account balances to complete and accurate figures for use on financial statements? When I was reading these, numbers C and D are obviously not the answer, so it's between A and B. Transfer the results of operations to owner's equity, or to reduce the owner's capital account to 0. Hopefully, it's A is the answer. It's to transfer the results of operations. And every time I click, I lose my chat. Well, that's not going to work well. How's that? Okay, so question 1 is A. And fees income account is closed by debiting cash and crediting fees income. Second one is debiting fees income and crediting income summary, or debiting the owner's capital account and crediting fees income. And D has crediting fees income. Well, fees income is a revenue account. Revenue accounts carry a credit balance. So to close that account to 0, you'd have to debit fees income account. So which one of these are debiting fees income account? It's not A, it's not C, and it's not D. So it has to be B because you're debiting fees income account and crediting income summary. The owner's drawing account is closed by, well, let's think first. The drawing account is an equity account, but it carries a debit balance. So to close it out, you're going to have to credit the drawing account. So this isn't debiting it. This is not crediting it. This can't be, I'm sorry. This is crediting the drawing account. This is crediting the drawing account. So it has to be B or C. So do we debit the capital account and credit the drawing account? Or do we take it to income summary? What do you think, Katie? Is it B or C? Yes, Katie, you're correct. It's B. So which of the following accounts would be closed? Supplies expense, accounts receivable, supplies, or accumulated depreciation? You only close revenue, expense, and drawing accounts. So it would have to be an A. The entry to close, the income summary account may include a debit to income summary and a credit to owner's capital. Or do you impact income summary and cash? No, cash is not impacted when you close the income summary account. So B and C are incorrect. And you don't take it to the drawing account. So it has to be A, debit to income summary and credit to owner's capital account. Correct, Katie, and A. So entry to transfer a net loss to the capital account would include a debit to so you're going to transfer the net loss. The debit is going to be let's see, the owner's capital account, and a credit. Cash doesn't have anything to do with it. It's a loss. So the owner's drawing account, nope. Income summary, and a credit to, nope, that's backwards. It's a debit to the owner's capital account and credit to income summary. It has to be D. Because it's a loss. And so it has to be a debit to the capital account. And in the income summary account, since it already has revenue and expense in it, and the company has a loss, it's got a balance of a debit. So it has to be D. And we'll do two more of these, and then we'll go to the next chapter. So after the closing entries are posted to the ledger, each expense account will have will it have a debit balance, a credit balance, either or none of the above? This is the case where it will be none of the above, because each expense account throughout the closing process is zero. You're zeroing out the expense accounts, each revenue account, and the drawing account. You're setting them to zero. So this one has to be none of the above. And lastly, which of the following accounts, well, there's only 10. Okay. Which of the following accounts will appear on the post-closing trial balance? The drawing account, income, owner's capital, or rent expense? Well, it has to be owner's capital. So very good on that. So let's go to chapter 7. A firm that sells goods that it purchases for resale is what type of a company? Is it a service company, a merchandising business, a manufacturing, or a nonprofit? It is a merchandising business. I think Katie left the computer by itself for a while. The sales returns and allowances account is classified as is it an asset, expense, revenue, or contra revenue? It's a contra revenue account. At the end of the month, after the equality of the debits and credits recorded in the sales journal is proved by comparing the column totals, the summary posting from the sales journal would include A. Is it a debit to accounts receivable, credit to sales taxes payable, and credit to sales? Or is it a debit to cash and credit to sales? No. Is it a debit to cash, credit to sales taxes payable, and credit to sales? No, that's a cash receipts journal. And a debit to sales taxes payable? No. So it has to be A. You increase your AR, you increase the liability for sales taxes, and then you have your sales. Detailed information about the transactions with credit customers and balances owed by such customers is provided in the, what do you think? General sales, general ledger, or the accounts receivable ledger? If it's by customer, it has to be the accounts receivable ledger. If the special journals, yes, Katie got that one right. If the special journals are in use, sales returns and allowances from credit customers may be entered in the general journal, cash receipts journal, sales journal, or general ledger. Where do you put sales allowances, sales returns and allowances? It would typically be in the general journal. If you adjust the sales journal, it could be sales journal, but it's typically the general journal. The question could it be B, cash receipts? This is a sales return. Oh. Okay. Exactly. So I think the true answer is in the journals it would be the general journal and not the cash receipts journal. Okay, so let's go to number 5. After all postings have been made, the total of the schedules of accounts receivable should equal the balance of the AR accounts in the general ledger, the total cash in the GL, the total of all sales in the account for the period, or the amount collected during the period. Well, the AR, schedule of accounts receivable, should tie out to the total of accounts receivable in the general ledger. It should be A. It has nothing to do with total cash, and it doesn't have to do anything to do with all sales, because some sales can be credit sales as well as cash sales. And the amount collected is a part of what goes into the balances, but not everything. So it has to be A. Number 7, the schedule of accounts receivable is prepared from, remember, the schedule of accounts receivable is a listing of all customers who have balances in your AR. So it wouldn't be the general journal, it wouldn't be sales, it wouldn't be the general ledger. It has to be prepared from the accounts receivable subsidiary ledger. That is where there's a T account for each and every customer. Correct, Katie? Suppose that the list price of goods is $1,000. Trade discount is 20%. What is the amount of discount, and what is the net price to be recorded in the sales journal? Is it 20 and 1,000? Is it 200, 800? Is it 200, 1,000? Or is it 800, 200? So the question is the discount and the net price. Well, the discount is $200, and the net price would be 1,000 minus the 200, or 800. So this answer would be answer B. Merchandise is sold on credit for $500 plus a 6% sales tax. The general journal will include a debit to AR of how much? How would you calculate that? The answer is 530. Yes, it's 530, which is, okay, this is accounts receivable. So when you purchase something on accounts receivable, you have to pay the price for the item, plus you have to pay the company the sales tax on that item. So I just took 500 times 0.06, and that is $30. So we have to pay the $500 plus the $30, or 530. And the last one for this chapter is when a sales tax return is prepared, the amount of the firm's taxable gross sales for the month are computed as cash sales plus credit sales less sales returns and allowances. I like that answer, but let's look at the other three. Credit sales less returns and allowances, well, that's missing cash sales. C is cash sales plus credit sales, but that's not being affected by sales returns. And cash sales plus credit sales plus the returns. No, it has to be A. And that's the quiz for this chapter. So, Katie, can you speak for the whole class? Is this helping? Is this a good exercise to continue to do? Okay. She says yes. So we're going to continue on to chapter. What chapter were we on? 6, 7. This has to be 8. Thank you. This was 7. Okay, this is chapter 8. So the entry to record a purchase of merchandise on credit includes a debit to accounts payable? No. A debit to sales? No. Has to be one of these last two. So you purchase merchandise. So would you be impacting accounts payable or accounts receivable? So it's going to be a debit to purchases and a credit to accounts payable because you are recording a purchase on credit. So which of the following statements are correct? The purchase requisition is the form sent to the supplier to order goods. The purchases account is reported on as an asset on the balance sheet. No. To the customer, a supplier's invoice is a sales invoice. No. To the customer, to the customer, it's not their sales invoice, it's their vendor invoice. Credit terms 210 net 30 allows the customer to take 2% discount if payment is made within 10 days. That's a correct statement. So credit terms 210 net 30 says 2% if you pay within 10 days, else you pay the net amount, and that's due within 30 days. The purchases account? Yes, it was D. The purchases account is a permanent account, a temporary account. We don't even know what subsidiary accounts are. They don't exist. And a liability account. Well, it's a temporary account that will close into either cost of goods sold or to inventory. Purchases of merchandise on credit should be recorded in, is it the purchases journal, general journal, cash payments journal, or sales journal? Well, the last two are ridiculous. Purchases of merchandise is not in a sales journal, and it's on credit, so it has nothing to do with cash. Is it purchases journal or general? Yes, it's the purchases journal. Credit terms of 110 net 30 means the full payment is due 30 days after date of invoice. Well, that's part of what it means. If the invoice is paid within 10 days of its date, a 1% discount may be taken. Otherwise, the total amount is due in 30. I like that one. Payment is due in full 10 days after. No. If the invoice is paid within 10 days of its date, a 1% discount may be taken. Otherwise, the total amount is due in 20 days? Has nothing to do with about 20. So it has to be B. Somehow my computer doesn't like this quiz. The detailed information, I think this has already been answered. The detailed information about the individual accounts for all creditors is provided in the accounts payable ledger. It's got a T account in there for each and every vendor that you owe money to. If special journals are in use, purchases returns to and allowances granted by suppliers may be entered into the, well, wouldn't be cash, it wouldn't be general ledger, it would either be general journal or purchases journal. It's the purchases. If special journals, I don't think purchases journal has returns in it, so it would be general, just like the accounts receivable that we did earlier today. So Katie's doing well over there. The schedule of accounts payable is prepared from the accounts payable subsidiary ledger. That's the only place where each of the vendors has a T account in your ledger system that gives you the balances. Net delivered cost for purchases is calculated as follows. So net delivered cost for purchases. Purchases plus freight in plus returns and allowances. Nope. Purchases less freight in. Nope. Purchases plus freight. less returns and allowances. I like C. And what's the last one? Purchases less. No, it has to be C. It's the cost of the product itself plus how much you have to pay to get it onto your loading dock minus any returns you've made. So it has to be C. And the last one in this chapter is, which of the following is an objective of internal control of purchases? Is the internal control of purchases to create written proof that purchases and payments are authorized? Is it to create a disciplined work environment? Is it to make sales process more complex? Or is it to create a more organized invoices? The only answer there has to be A, is to create written proof that purchases and payments are authorized. So that was chapter 8, and I think chapter 9 is the last chapter in this mod, which is on cash receipts, cash payments, and banking procedures. So when you make a cash sale of merchandise, where would you record that? Would you record that in the sales journal, the general journal, or the cash receipts journal? Yes, cash receipts journal. Remember, the sales journal is only for credit sales. When you receive cash, it has to be on cash receipts journal. Upon collection of the amount due. Well, let's go back here a second. Discussing between cash receipts journal and the sales journal. After the cash receipts journal has been posted to, that information goes to that's important information for the person responsible for managing cash, and the account and the bank reconciliation, and who takes that cash to the bank. It goes into the cash management process. Sales journal goes into which department in a large company? That goes into management by the AR department, the collection people, and they're responsible for keeping the accounts receivable ledgers in sync. So this feeds into AR, and this feeds into Treasury. Okay, so number 2, upon collection of amount due on an interest-bearing promissory note from a customer, the accountant would debit cash, credit notes receivable, and it wouldn't be a debit, so the debits are out. It would either be credit to interest income, or credit to interest expense. Yes, you would credit interest income. So you would debit cash, and the cash you received would be for the principal and interest. So you would credit notes receivable and credit interest income. So B. Most businesses use petty cash fund to pay for accounts payable, small expenditures, office lunches, or internal expenses. Yeah, those small expenditures. Quite often it's cash on delivery. When you send something COD to a company, they have to pay right then. It could be sending someone out for postage. It's any of those small kind of nuisance type expenditures. Which of the following statements is correct? The entry to record the payment of an invoice within the cash discount period would include a debit to purchases discount account. Well, purchases is a debit account, so it wouldn't be discounted with a debit. So A is not the right answer. The entry to a cash purchase of merchandise would include a debit to purchases and a credit to cash. There's nothing wrong with that statement. How about a transaction that is properly recorded in the cash payments journal will always include the recording of an amount in the cash debit column. Well, cash gets increased with a debit, decreased with a credit. And this is the cash payments journal. That's totally backwards. And the purchase discount is a contra revenue account. No, it's a contra purchases account. The only answer is B. So number 5, the payment of a purchase invoice when a cash discount is taken includes a debit to accounts payable. I agree with that. So these first 3 are potentially correct. The 4th one is not. So we debit accounts payable, and this is a payment of a purchase invoice, and you credit discounts and credit cash. Or you debit purchase discounts and you credit cash. Or you credit cash. You just don't credit cash because you have that cash discount. Accounts payable, you debit the discounts. It's A. The purchases account will have a debit balance normally, so you have to credit the discounts and then credit the cash. The answer is A. So if you have a $1,000 purchase of which you had earned a $100 purchase discount, your accounts payable will be $900. The credited discounts would be a credit. The AP would be debited $900. Purchases discount would be credited $100. No, I'm backwards here. You debit accounts payable for the whole 1,000. You credit purchases discount for 100, and you credit cash for 100. So it has to be A. 6, at the end of the month, after the equality of the debits and credits recorded in the cash payments journal is provided by comparing the at the end of the month, debits and credits equal in the cash payments journal, and that's provided by comparing the total columns, the summary posting from the cash payments journal would include, so in the cash payments journal, payments journal would include a debit to accounts payable, a credit to purchase discount, and a credit to cash. In addition, the amounts in the other accounts debit column would include posted as debits to those accounts. Yes. Debit, credit, in addition. No. It is A. Debit to accounts payable. Okay. Continuing on. Good job, Katie. So our last 4 will be the entry to replenish a petty cash fund includes a debit to cash and a credit to petty cash? No. A debit to petty cash fund and a credit to cash. This answer B is how you establish one. Once you establish one, the entry to replenish it is different. And we're asking for the replenishing entry. But this entry B is how you establish one. You debit petty cash and credit cash. When you cash that check, then the cash that you get from the bank is your petty cash fund. But that's not to replenish it. You debit various expense accounts and credit the petty cash fund? No. You debit various expense accounts and credit to cash? Yes. And when you take that check to the bank and cash it at the bank and you get the cash for the credit here, then that goes back into your petty cash fund for continuation. So this is answer D. The check issued for $890 to pay a vendor on account was recorded in the company's records as $980. The canceled check was properly listed in the bank account as $890. To arrive at an accurate balance on the bank reconciliation statement, the error should be added to the book balance, added to the bank statement balance, deducted from the book balance, or deducted from the bank statement balance. So it's going to be added to the book balance. The game we play in a reconciliation is you begin with the bank statement balance, and then you add or subtract anything that the bank doesn't know about yet. Those are checks that you've written that haven't been cashed, deposits that were made after the statement was produced. So you're playing that type of a game. And then the other part of the cash reconciliation, bank reconciliation process is taking your journal balance, your general ledger balance for cash, and adding and subtracting items that the bank doesn't know about yet, like service fees, collections, whatever. So the bank, you issued a check for $890. The bank balance the bank statement has $890 in it. It's your ledger that is off. So since you recorded a larger amount for the check than the check actually was, you have to add it to your book balance. Because if you went in and could take a magic eraser and erase the 980 and put in 890, your checking account balance in your books would be increased. A firm's bank reconciliation in part shows a book balance of $15,820, a deposit in transit of $300, an NSF check of $400, and outstanding checks totaling $10,000, and a service charge of $20. And its adjusted book balance is, how would you calculate that? Well, the book balance is $15,820. And they're asking for the adjusted book balance. So you have a book balance of $15,820, a deposit in transit of $300, but that would affect the bank side of it. An NSF check of $400. So you have to subtract $400, and an outstanding checks totaling $10,000. That's a bank side, and a service charge of $20. The book balance would be $15,400. The bank knew about the service charge of $20, and the accountant didn't. So we had to take that $20. Outstanding checks, your balance knows it, and the NSF check of $400 needs to be subtracted from your bank balance because you deposited it, but it was a bad check. So the bank reduce their balance, and now you know that that check is bad. And you know the check, give me a second here. You know that the check is bad, so you have to subtract it from your ledger balance and put it back to accounts receivable. So 15,400. And the last one is if a check written by a firm is not canceled by the bank, is returned with the month's bank statement, the firm should adjust the balance in the company's account. I immediately notify the bank requesting that it corrects its records. You need to do B. And consider this check as outstanding when preparing. If a check is written by the company, it's not canceled, but it got returned in the bank statement, you need to contact your bank because the bank didn't reduce their records. So they have to correct their bank statements. Because they processed it, they just didn't cancel the check, the bank. So that's the answers to the chapter quizzes for Accounting 102. I hope this has been very helpful. I have enjoyed working with each and every one of you in this mod, and hope to meet you someday soon virtually in another course. Take care, and good luck with your final exam.